If you're new to crypto trading, then you need to know about the head and shoulders pattern. It's a game changer. The head and shoulders pattern is a classic chart formation that signals potential trend reversals. It's named for its resemblance to a head between two shoulders. Imagine a price peak. That's the head, with two smaller peaks on either side. Those are the shoulders. When you spot this pattern, it often means the asset might switch directions. First, look for an uptrend leading to the first shoulder. Then, a higher peak forming the head. Finally, a second shoulder appearing, usually at the same level as the first. The key moment is when the price breaks below the neckline, the line connecting the two shoulders' lows. This breakout can signal a downtrend. Remember, no pattern is foolproof, but understanding the head and shoulders can give you an edge in predicting market movements. Start spotting these patterns and take your trading skills to the next level. In this chapter, we will dive deeper into the psychology behind the head and shoulders pattern and how it affects market sentiment. The head and shoulders pattern is not just a visual cue, it reflects the psychology of market participants. When the first shoulder forms, traders are optimistic, pushing the price up. As it peaks to form the head, this optimism turns into exuberance. However, when the price fails to reach new highs and forms the second shoulder, doubt starts to creep in. This doubt is crucial. It signals that the buying momentum is weakening. As the price approaches the neckline, traders who bought at higher prices begin to panic, leading to a sell-off once the neckline is breached. This collective psychology drives the market into a downward trend. Let's look at some real-world examples to solidify your understanding. Here we have a chart of Bitcoin from 2018. Notice how the head and shoulders pattern predicted a significant downtrend. Another example is Ethereum in 2021. Despite an initial rally, the formation of the second shoulder indicated a bearish reversal. Understanding these psychological cues can help you make more informed trading decisions. It's not just about recognizing the pattern, but also comprehending the market sentiment behind it. This knowledge can give you a strategic advantage in your trading journey. Stay tuned for more insights and case studies in our upcoming videos. Now that we have a solid understanding of the psychology behind the head and shoulders pattern, let's dive into its variations. One of the most notable variations is the inverse head and shoulders pattern. The inverse head and shoulders pattern is essentially the mirror image of the traditional head and shoulders. Instead of signaling a bearish reversal, it indicates a potential bullish reversal. This pattern is typically found at the bottom of a downtrend. When the first shoulder forms, traders are pessimistic, pushing the price down. As it dips further to form the head, this pessimism turns into panic selling. However, when the price fails to reach new lows and forms the second shoulder, hope starts to creep in. This hope is crucial. It signals that the selling momentum is weakening. As the price approaches the neckline, traders who shorted at lower prices begin to cover their positions, leading to a rally once the neckline is breached. Identifying these patterns can be challenging, especially in different market conditions. In a volatile market, the patterns might not be as clean and well-defined. It's essential to look for additional confirmation signals, such as volume spikes and other technical indicators, to validate the pattern. Let's look at some real-world examples. Here, we have a chart of Bitcoin from 2019. Notice how the inverse head and shoulders pattern predicted a significant uptrend. Another example is Ethereum in 2020. Despite an initial downtrend, the formation of the second shoulder indicated a bullish reversal. Understanding these variations and how to identify them in different market conditions can significantly enhance your trading strategy. Remember, it's not just about recognizing the pattern, but also understanding the market sentiment and using additional signals for confirmation. Stay tuned for more advanced trading techniques and insights in our upcoming videos. Don't forget to like, subscribe, and hit the notification bell for more expert tips on crypto trading. In this chapter, we will focus on the technical indicators that can be used in conjunction with the head and shoulders pattern to confirm its validity. One of the most commonly used indicators is the Relative Strength Index, or RSI. When you spot a head and shoulders pattern, check the RSI to see if it supports your observation. Another valuable tool is the Moving Average Convergence Divergence, or MACD. When the MACD line crosses below the signal line during the formation of the head, it can serve as a strong confirmation of a bearish trend. By combining the head and shoulders pattern with these technical indicators, you can make more informed trading decisions. Chapter 5. Let's discuss risk management strategies for the head and shoulders pattern. Place your stop loss just above the high of the head in a standard pattern, or below the low in an inverse pattern to minimize losses. Risk no more than 1 to 2% of your capital on any trade. Diversify your investments to reduce overall risk. Use trailing stop-loss orders to lock in profits. Preserve your capital to continue trading successfully. The final segment of our deep dive into the head and shoulders pattern. Let's unlock some advanced tips and tricks to elevate your trading game. Combine the head and shoulders pattern with Fibonacci retracement levels. Identify key support and resistance levels to enhance your entry and exit points. Use multi-time frame analysis for a broader perspective. Confirm patterns on daily, 4-hour or 1-hour charts for robust signals. Consider volume analysis to add credibility to the pattern. Increasing volume on the left shoulder and head, followed by decreasing volume on the right shoulder, confirms the pattern. Keep an eye on broader market conditions and adjust your strategy accordingly. Thank you for joining us. Like, subscribe, and hit the notification bell for more insights. Until next time, happy trading.